Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. I'm absolutely thrilled to have with us Marcelo, who is the co-founder at KPK. And we've known each other through the Ethereum and Web3 ecosystem now for a couple of years. I'm really interested in KPK as a firm. It's an on-chain asset management firm that has gone through DAO transitions, various treasury management approaches, and is one of the best players in the space. With that, Marcelo, welcome to the conversation.
Thank you. I'm glad to be here with you, Alex.
So let's just lay down the basics. What is KPK and what does it do?
KPK is an on-chain asset management organization that was born around 4 years ago with this mission to how to manage treasuries in an Ethereum way, following Ethereum values for a DAO, which in that moment was Gnosis DAO. It was the first organization that was becoming a DAO. They had a very big treasury, $1 billion. So the challenge was how to manage the funds in a non-custodial way, following very strict security and risk management practices. So that's how we started making these proposals, working on governance.
You were part of Gnosis at the time when you started doing that?
Yeah, that's right. That's right. KPK is a spin-off of Gnosis, but then became independent. And then we started managing the treasuries of ENS, Balancer, COW. And now we manage or advise more than $2 billion in treasuries, including the Ethereum Foundation and other big DeFi protocols.
Let's spend just a little bit more time, I think, on those early Gnosis years, because I think many of our listeners will come from finance or fintech worlds, and they're not going to know the unique challenges of dealing with what you went through, right? So Gnosis was a project that had an initial coin offering and raised quite a bit of money. How much was sort of the total ICO proceeds at the peak?
So back in the day, it was one of the first ICOs. They raised around $15 million in ETH, which they never sold. That's why it got to this $1 billion amount. And the main difference, I think, for managing assets on chain is this idea that when you have an organization that is 100% based on chain, absolutely every contract, every activity needs to be on chain, because many of these organizations don't have legal recourse. So we were somehow forced to do absolutely everything on chain. And that means making sure anybody who would actively manage the assets would not be able to run away or to have custody of the funds by any means. So that's how we built, on top of Safe, on top of roles and Zodiac, a modifier, sort of permissions to allow these very granular management assets within a predefined set of smart contracts. So that's basically, that's how we started.
It's an interesting origin story because I think Gnosis, the ICO, the original idea was close to, and again, correct me if I'm wrong, something like Polymarket today, so prediction markets on the internet. The financial size of the raise, sort of the gravity of it, transformed what had to be done. And if all of a sudden you're sitting on $1 billion and it's completely on chain, you have to develop all of the infrastructure for asset management in an industry which didn't have any of the pieces, right? If you look back to 2018, not even non-custodial MPC or anything like that. And so Gnosis kind of splintered into a whole bunch of different business units, including Gnosis Safe, which is now a multi-billion-dollar sort of institutional on-chain wallet management system, non-custodial custody, into payment services, and then into KPK, which is sort of the investment management recommender as well as software, right? Like you guys have your own infrastructure.
Yeah, exactly. So you mentioned this non-custodial MPC wallet. To get an MPC wallet, you need to sign a contract, because all of this logic is mostly off-chain. So that was the heart of everything we do, is 100% on-chain. And also at that time, the main challenge for all of our treasuries was how to continue existing, because in this very volatile market, we needed to make sure we had runway for paying to contributors. So low risk investment strategies was paramount, as well as making sure we wouldn't lose funds, right? Because we never really behaved like a hedge fund. We were never chasing for yield. We were chasing capital preservation.
Got it. So what was your entry into realizing you needed to make investment decisions with the Treasury? And maybe in those early days, like, do you remember the first investment recommendation that you and the team had made? And like, who did you make it to? And what was the context? Like, who were the relevant players at the time?
So this was in the beginning of DeFi Summer 2020. There was this point where all of the assets in this treasury were not being utilized in any way. So that's when we started getting yields of 50%, 100%, all of these insane returns due to these new governance tokens. It was very clear that all of these treasuries were leaving money on the table. That's why when it really made sense to start thinking of ways to manage assets, but at the same time keeping these organizations with a custody of the funds at all times, and without outsourcing the funds. So the key decision makers here were, when it came to proposals, token holders, delegates, usually founders, because traditionally they are the largest token holders, investors. In the beginning, the process involved a lot around governance, engaging with the risk appetite of these projects. With time, when they realized we were serious, we had good risk management practices, we were trusted by many other players. At the end, for the most part, we were the ones making the decisions and creating these investment policies for these projects and following those investment policies.
Were you inspired by any traditional asset managers in creating the investment policies? Or like, did a lot of it have to be kind of de novo? And then what kind of engagement from the community or from the DAOs did you need to get the implementation to get going?
I think that the inspiration came from avoiding most of the players at the time who were very risk tolerant, very, our industry is full of degens. So the inspiration came from, okay, let's do exactly the opposite. Let's aim for very, very long-term. Let's aim to build a reputation and make sure we are very serious with this when managing this fund, because it's very serious. It's runway money. The main goal for this project is to fulfill the mission and the visions of these DeFi protocols. Like the mission of Aave is much more important than any yield, any return they can get from their treasury. So I think, maybe like an inspiration to be different.
How did the complexity of investment strategies evolve, like over the next couple of years as you went through DeFi Summer and then the FTX crash? I'm sure lots of people wanted to do capital preservation and generate yield, but most crypto treasuries were completely caught, out of position, lots of exposure to their own token. Can you talk about those following years and just the evolution of what you saw in terms of what your clients wanted and what they could get done?
In the first years, negotiating early allocations for these projects as liquidity providers from the treasuries was, I think, probably the most profitable strategy, because we would have this arbitrage. We would know that the teams, a few teams were building safe DeFi protocols, but they could not bootstrap funds, blood for their DeFi protocols. I'm thinking about DEXs, fixed market protocols, options protocols. So in the beginning, it was mostly about that. That was very profitable. Then when the bear market started, most of us started thinking in, how to tokenize Treasury bills, because there was this inflection point where T-bills rate were higher than the rates you could get on chain. So there was a big flow into these real world assets. Now it's changed again. Usually in bull markets, rates on chain start being very interesting. So yeah, we've had this changing strategies based on macro environment. And also we started having these new protocols, for example, these fixed yield protocols where as a treasury, they were very attractive. And then always the basic DeFi primitives, lending, borrowing on Aave or Sky, market making with these automatic strategies on Uniswap, Balancer. They were always, I wouldn't say low risk, but definitely we understood those risks, so we were able to manage them.
So let's take them one at a time, right? Because I think they're well known to you, but they're not well known to everybody else. You started saying the lending strategies at Maker, maybe Aave. Can you walk us through two things? One is, how did you assess what qualified as a good enough DeFi protocol for a treasury to put meaningful amounts in, number one? And then number two, what is the investment strategy that you liked, or in this case, what do the protocols provide you?
So, these lending protocols are the basic primitives. Yeah, lending is a basic primitive of any financial system, and DeFi is not different. So we had these money markets like Aave, where people can borrow and lend pooled assets. Then we also have Sky, that, in a similar way, but they would create this stable coin that in some form behave like a private central bank. Was a very interesting concept. Now Aave also has this Go stablecoin. So how we assessed the risk in the beginning, there were a lot of hacks with lending markets, and the big players were able to serve this through very strict risk management practices, hiring very competent risk management providers, managing the risk, and also later on doing formal verifications of their contracts, making sure that's really the standard, the safest security practice. Also very expensive because it's very resource intensive. So it's really choosing the protocols who have the experience against this very adversarial environment. We have even state actors like North Korea trying to attack all of our protocols constantly. So it was a combination of Lindy effect, the track record, all of the experiences from these hack attacks, but also speculative attacks, very complex financial engineering attacks to create bad debt in the lending markets. Now we can say it's the big ones are ready, are mature for institutional use, I would say. Then you also mentioned strategies. There's a few strategies depending on risk appetites. One that was working very well for some time, and it's still, depending on the timing, it can work very well, is using your crypto collateral, borrowing stable coins. Usually you can do it usually at a low rate on Aave, and use those stable coins to farm higher risk opportunities and, let's say, L2 protocols who are very thirsty for stablecoins and are willing to pay extra incentives. So then basically, carry trade of stablecoins. Then another one that was interesting, and it still is very interesting in protocols like Morpho and Aave, is leverage. Being able to get a yield, and if you're bullish, and the yield, you can use it as use a yield-bearing token as a collateral, borrow a stablecoin, and buy more of that yield-bearing asset and deposit it again as a collateral. That's basically leveraging any yield-bearing asset in a way that is, I think, much more efficient than synthetics leveraged ETFs. So I think that's. But yeah, I could go on. I don't know, like
you absolutely should go on. Yeah. So just to play back what I'm hearing, right? So in something like Sky, well, first off, you can deposit collateral and get a stablecoin. You can also deposit a stablecoin and get Treasury-ish equivalent yield. And then in the lending markets, you can deposit an asset and get paid for other people who are borrowing it, sort of like in a margin account. But you can also use the receipt token for the underlying and then loop it several times. And I think I read somewhere a while ago that given that you need to be around 50% collateralized, give or take, like the most leverage you're going to get on the loop is somewhere around 3x. Like it's not, 40x perpetuals. Is that correct?
That really depends on the expected drawdown of that asset. For assets if the leverage is for assets that are heavily correlated, like the case of derivatives of the same token, for example, let's say staking derivatives of Ether or yield-bearing tokens of stablecoins, the leverage could be higher, but still, well, the risk of liquidation is very high, and usually liquidations are very expensive. So we try to avoid them at all cost. Yeah.
What would you recommend to a modest DAO with $100 million treasury, and I'm looking at leverage, I'm looking at stablecoin yields? What would you recommend for me? Like, should I sell my own token to go into USDS and get my 5% from Sky? Like, how much leverage should I get? What are the parameters there?
If you're a treasury of this DeFi protocol, or I would really make sure there are enough runway. I would try to do as low risk as possible, like this. Yeah, T-bills. I would say it's very different if the goal of the treasury is getting yield, or maybe bootstrapping the Ethereum ecosystem, like with these new Ethereum treasury companies. So I think it really depends on the risk profile of this organization.
What are the risk profiles that you've seen? How do you assess risk profile outside of we need 4 years of runway? Is it the personality of the founders? Is it the voice of the community? Like, how do you boil it down?
Yeah, it's a combination of all of that. I would say from the treasuries we manage, ENS is the one that is most conservative, not only from risk, but also they're very values driven, which means that they want to invest their Ether in something that will help Ethereum, the Ethereum network, for example, investing in liquid staking providers who stake their nodes in minority clients to help the health of the network, or avoiding investing in any DeFi protocol that might represent a centralization of Ethereum or a weak spot. So you can imagine there are many constraints which force us to do very, very low risk, simple strategies. So that would be an example of a very low risk. Then the ones who are much more risk tolerant usually go for private deals, because it's possible to negotiate these early liquidity mining programs or these promises of points that were very, very popular with the risk-taking infrastructure. So, yeah, many of them means investing in projects that are still not proving, are still bootstrapping liquidity and need to prove that they can deliver value. So in some sense, the treasury as liquidity providers is I wouldn't say a VC, but it starts getting similar to VC risk for these funds. Yeah.
Just one more question before moving off of this. You had mentioned using stablecoins to farm other L2s who are willing to pay for stablecoin supply on their markets. How does this happen in practice? Like, again, let's say you have a chunky allocation from this 100 million Treasury, which is saying put 10 million into USDS, and then you find out that Arbitrum or someone else is offering rewards, right? Like, how do you think about the bridging risk and the smart contract risk, bear a chain or whatever, and how do you go out further on that stablecoin farming frontier?
Yeah, so first there is a technical evaluation of the protocol. If the position justifies it, we would do some internal smart contract audit. Then let's say, depends if it's a crypto foundation or a company, the process for decision making is very straightforward. It's basically just depositing the funds. But if it's a DAO, an on-chain organization, usually requires more engagement. Creating a proposal to add the permissions to invest in this new protocol. So that usually requires approval from the DAO through a governance vote. You can think of these DAOs as, like governments, because everything is public. Anybody can give their opinion. Any token holder has a voice. So once these allowances for working these new protocols are approved by the DAO, then it's possible to do these deployments in these new chains or these new protocols.
Have you had a situation where you knew there was a smart asset allocation strategy and sort of the founders and core contributors agreed, and then, somebody in the community who is just blew the whole thing up? Does that happen?
I think, yeah, for sure. So we have, so for these DAOs, all of the proposals, let's say the contracts are public, but we're still humans. They are informal networks. Many of these deals happen behind the scenes. Many times contributors or community members don't really know what's happening. They don't have enough information that can create a conflict. Usually it's solved when somebody trusted in the community gives their opinion, somebody like the founder. So usually everybody aligns behind the founder. But those conflicts are, definitely very common in the DAO space and this crypto foundation space.
You mentioned another strategy, which was providing liquidity into decentralized exchanges like Uniswap and maybe Hyperliquid or others. I've definitely lost money trying to do that, and I feel like it's gotten quite complicated as the dexes graduate from V1 to V2, 3, and 4 to the intense world where it's like quite technical. Can you talk about the viability of liquidity provision strategies and any sort of advice for allocators that have a conservative outlook?
Providing liquidity on these dexes short term is quite risky because of the stock risk you are committing and also impermanent loss. Usually these strategies play very well long term if you're able to provide liquidity on a place like Uniswap, Balancer for a long period of time. And when I say long period of time, I mean a complete cycle. If you're able to provide these funds for a complete cycle, then all of the fees you get for market making, let's say that the fees the users pay for using the pool of the assets you provide, is usually larger than any risk you can get from toxic flow or impermanent loss. So this is strictly talking about these automated money market strategies. Then on Hyperliquid, that's a different story because it's possible to farm the funding rate. This is something that is very popular. And then leverage, but that's something we don't usually recommend because it's super risky with these very high volatile markets.
So if you were to put it all together, and you look at your firm today and the people in the firm and the types of strategies that you think are appropriate, we are in a pretty aggressive market at the moment. ETH is recovering. A lot of the DeFi protocols that may have treasuries are now generating revenue. They're doing token buybacks. When you look at where we've come to in terms of all the infrastructure in place to manage money, to do self-custody, and so on, what's a template for success? Yes, there are differences in terms of risk tolerance and goals and so on. But, if somebody comes to you today, where do you point them to in terms of structuring their on-chain treasury, the tools that they use and the correct ways to get started?
So I would point them to the OG DeFi protocols. I think, it's been almost a decade of development. These foundational protocols have matured. They're now resilient infrastructure, and they've operated through all of these market cycles without major failures. Yeah, I don't think these are experimental any longer. I would definitely point them to the ones who are to the OGs. I'm thinking, Uniswap, Aave, Lido, MakerSky, Balancer, Gnosis.
And when you look at the team that you've built in the company, what are the functions that people split into? Because I think you've had pretty fast growth in terms of headcount. Are most people investment and finance people? Are they developers? Are they salespeople? How do you look at the company as a structure?
Yeah, right now we're around 50% operations. Those are financial engineers, people with finance background, but they also need to understand smart contracts. Then we have a team doing engineering and product for the on-chain investment vehicles we are developing. Also, something very important is the governance team that acts as a nexus between the asset management teams and the community's delegates. Yeah, I would say that most of us are engineers.
So the challenge is getting the money into the right place and then getting the community to say yes to the sort of the conservative investment decision rather than trying to sort of boil the ocean and do something super complicated.
Well, yeah, exactly. But also the main focus is how to avoid an early depeg, how to remove liquidity programmatically if there is a liquidation cascade, how to prevent or act very quickly in one of these speculative attacks. So many of us are working hard with service providers like Hypernative that provide alerts to automate many of these risks. So I would say investing is the easy part. Remaining without any losses, that's the tough part.
It's a funny thing to say about what's supposed to be this hyper automated, robot financial system where smart contracts and cryptocurrencies make everything easy. And it sounds like operations and the human management side is the most complicated part.
Yeah, I agree. So OPSEC is the operation security of the team, emergency processes, making sure we can react 24/7 if there is something that is unexpected and was not automated. That's a big challenge.
So I want to switch gears a little bit and ask about this next wave of developments in the industry, which is the launch of a number of really large public equity companies that have an Ethereum focused treasury. And so we have things like SharpLink, Dynamics, Thomas Lee's Fundstrat's equity vehicle. And the playbook for these companies is to go raise either in-kind ETH or dollar capital. And they do this either by issuing debt or by issuing equity, and then using that to acquire a whole bunch of underlying Ethereum, and in other cases, of course, Bitcoin, as it was with MicroStrategy, or now, longer tail assets, whether it's Athena or Solana or Hyperliquid or BitTensor, Treasury companies are everywhere. And the market rationale for this is that public equity investors often have a mandate to, hold individual securities, and they might not be able to reach and hold on-chain tokens. And so this is sort of a substitute for them to access the new asset class. I'd love to get just your reaction to the trend, and then we can dive into how these companies should be managing the Ethereum on their balance sheet.
Everything we do is Ethereum based. We're very, very excited with these Ethereum Treasury companies that are emerging, especially the ones who are following the book of Michael Saylor, because he did some very smart financial engineering, especially from the debt side. Because, by raising debt, they created these convertible bonds that allows lenders to convert the bond to the stock at a premium. So the interesting thing is these lenders keep the upside for the stock, but also are protected for the downside, because in the worst case scenario, they would just remain with a very low coupon bond, or now they've been issuing zero coupons. So that's very, very, very smart. So kind of having a leveraged BTC with a protection for the downside. And I'm excited because we could offer those things on chain, on DeFi for Ethereum Treasury companies. So basically giving these opportunities for lenders to retails, DeFi protocols. So I think that's very exciting. Also, the obvious thing is, well, on Ethereum, you can get actually yield. So on Bitcoin companies, you basically have, in the best case scenario, just a high beta leveraged Bitcoin bet. And that's okay. That's interesting for big players who want to invest in strategy and want to somehow front run acquiring, let's say, cheaper Bitcoin. But the interesting thing for Ethereum Treasury companies is that they can really build revenues, all sorts of revenues. They can get revenues and take value from centralized exchanges by providing liquidity on these automated money markets and become the market makers, the largest market makers on chain. They can bootstrap all of these lending protocols and become like these, very big financial actors who can disintermediate all of these other centralized financial institutions. And basically, the company owning the capital could be absorbing all of these businesses. So I'm really excited for that. So basically, I mentioned two things: getting real revenues. I'm not only mentioning about staking, which is what's very popular today with these Ethereum Treasury companies. I'm talking about much more than staking. Talking about lending, borrowing, doing more complex financial strategies. So I'm very excited for that. I mentioned debt on chain. That's something that is going to be huge, very profitable, and it's going to democratize access to these preferred lending deals. I think this is very interesting. So everything I've just mentioned so far is ways to get more revenues, save costs on debt. But something I haven't mentioned, and I'm very excited, is the role of these treasury companies on the DeFi ecosystem. Because we've never had really, really mega whales, like $1 billion asset allocators on DeFi. That's something that we've always missed on chain. If you check the largest liquidity provider on the largest lending market protocol, that is Aave today, you will see that the largest whale deposits less than $1 billion. Usually it's not high quality collateral. And if you check on Uniswap, the largest pool of USDC Ether, which is the most popular pool for buying and selling Ether, is only $100 million. So when you see these things, it's very natural to understand why DeFi never scaled so far. Because the infrastructure is ready, the protocols are ready for institutional adoption, but still they're lacking blood. They're lacking the liquidity to make markets with, let's say, on DEXs, we have low slippage, debt. Then on lending protocols, we never had the liquidity required to be able to borrow, let's say, $100 million without changing rates, without heavily changing rates. I think this new wave of Ethereum treasury companies is going to definitely transform DeFi and take it to a global level, right? To a level where everybody's trading on-chain node because it's cool and it's permissionless, and you can hold custody of the funds, not because of that, but because you have the best execution, because you have the best price. And that's basically removing or sucking the air from all of these centralized players into DeFi. Yeah, this is not related to any Ethereum company in particular, but probably the sum of all of them. I'm very, very excited for that.
It's a very meaningful amount of ETH. And all the companies that I've seen launch are headed by people who are crypto native, which means they're going to take ETH and they're going to stake it at least, and then maybe access some of the stablecoin protocols and get some of the kind of smaller loops going on top. But if you do the math, that's like 3% to maybe 5-6%, I think you can squeak out. If you had $1 billion sitting in a public equity vehicle of ETH and you had a mandate to deploy it on chain, like how would you actually go about it? Which protocols you think are the right choice for a strategy like that, where you're still primarily exposed to ETH, but you are getting something else out of DeFi?
Yeah. I would like to elevate the stakes a little bit more. And instead of thinking of 1 billion, think of a $10 billion treasury, because I think that's possible in the short term. Strategies holding $70 billion of Bitcoin. If we assume there's going to be a proportional appetite on Ether, proportional to its market cap, that is a seventh or something like this. I think it makes sense to say that somebody like Sharplink, the company that is being led by Joe Lubin, the co-founder of Ethereum, makes sense to have a Ethereum treasury company with $10 billion in the short term. I think a $10 billion project could influence a DeFi at scale that nobody were able to do before. So I'm thinking this player could dramatically change the liquidity of Ether. Somebody depositing $2 billion of liquidity of Ether on DEX could do easily a 20x, 30x in liquidity. So basically only this player could make Ether more liquid than in any other centralized exchanges. So that would be a huge bootstrap of liquidity of Ether. And Ether as a reserve asset gets benefited from being more liquid. So you have a more liquid asset, you have less volatility, you have less spread. So that's the liquidity is probably, I would say liquidity is the most important property of a reserve asset. So only this whale could potentially make Ether more liquid than Bitcoin. So this is big. This is very big. And we only talk about DEXs, but the same would be if this player, let's say, of course, they would stake their Ether, but they will also get a liquidity staking token that is a representation of those staking assets that could also be used to provide more liquidity to Ether, and also do loop strategies, bootstrap all of the lending markets. So basically, only this whale, this $10 billion whale, could take DeFi to the next level. This whale could deposit this liquid staking derivative on a protocol like Aave, borrow all type of other tokens and do strategies with those tokens. Only this player could have, they could have their own liquid staking token and be a big competitor to Lido, for example. And this is just a start. If they tokenize their stock they could tokenize their debt. That would be a big bootstrapping, to these markets. Also, a large player, a $10 billion player, could bootstrap the insurance vertical of DeFi. That today, one of the most important players is Nexus Mutual, a project we manage here, manage their treasury. They need liquidity to make their offerings more competitive. So basically, every DeFi vertical needs more liquidity to be more competitive. So we see that all of this bootstrapping of DeFi ecosystem will, of course, be definitely translated to Ether price, creating this flywheel effect for the same treasury companies whose main goal is to increase their holdings.
I hope that the loop works. And I think we finally have the Enterprise Ethereum Alliance that we've all been hoping for since 2016.
Yeah, exactly.
Marcelo, it's been fantastic to have you on today. If our listeners want to learn more about you or about KPK, where should they go?
You can visit our website, kpk.io.
Thank you so much for joining me today.
Thank you, Lex. It was a pleasure.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.